I've been actively investing my own portfolio for the last decade plus, and for the last 6 years, I've been able to achieve over 36% compound annual growth rate. In this video, I'm going to share with you 7 ways that you can almost guarantee that you will lose everything investing and trading. And so these lessons are going to be the inverse of what it takes to actually make money. Sometimes it's easier to see the inverse, the things that you need to avoid, so that you know what you need to do instead. Starting off at number 1 is play the house when you can't control the odds. New traders and new investors always like to look at the lottery and casinos and say, hey, look, the way that these guys make a ton of money is by placing many trades where they're able to make a little bit of money across the board. Yes, sometimes the house loses a bunch of money, but they always make more money on everything else together to make up for what they lose on those big losses. If you're playing the house like a lottery, again, you make $1, $2 per lottery ticket, and then anytime somebody wins, you pay out a couple $100 million. But the key reason why the house, in other words, the lottery or the casino, doesn't lose money on this strategy is because they control the odds. When the lottery pays out to a winner, they've set up the odds in a way and they've controlled the pot in a way that they can't lose on it. And so the way to make sure that you guarantee that you lose when you're investing or trading is to play the exact same game in a place where you can't control the odds. During my first year of trading, I experienced my first blowup where I was playing this game. In other words, I was placing trades that had a very high probability of success, and therefore I made a little bit of money on each trade. Because I looked at what I thought the odds were, or what the statistics said the odds were, said, look, my probability or the odds of me losing on one of these trades is so small that I'm comfortable executing a ton of these trades and taking on more and more leverage. So my portfolio in the beginning started to grow very quickly. I felt like a genius, but because I was playing a game where I couldn't control the odds, an unexpected move happened in the market. A 3 standard deviation move happened that I thought was virtually impossible, and I blew up. Lost about 90% of my portfolio on one trade that went the wrong direction. Sometimes people call this type of strategy picking up pennies in front of a steamroller. So if you want to make sure that you lose money trading and investing, you want to do exactly that. Play the house where you can't control the odds. This means that the inverse of this would be to make many small trades or small investments that have high asymmetric upside but low downside. All right, the second way to make sure that you lose everything trading and investing is to go all in. Young traders like to call this YOLOing. You only live once, so might as well throw everything in. They say, hey, well, I've only got $1,000 or I've only got $10,000 and that's not going to do me any good on its own. So might as well go big or go home, throw it all in on something and hope I make a bunch of money because if I lose it, I lose it. And my life doesn't really change that much anyway, especially when they see stocks, meme stocks, NFTs, cryptocurrencies, option trades, whatever it is, and they see the profit potential and that's what they focus on. So they say, hey, look, if I only put a small percentage of my portfolio in this, it's not going to make a huge dent in my life. So because the profit potential is so big, I'm going to go all in on this. The reason why this is such an effective strategy for losing everything investing is because losses are always more powerful than gains. Let me show you what I mean. If you start off with 100% of your portfolio, let's say you've got $100,000. A 10% loss will bring you down to $90,000. However, to get back up to $100,000 just to break even, you need to go up $10,000 from there, which is not 10%, it's actually closer to 11%. So the same dollar amount is a smaller percentage of large number, larger percentage of a small number. So it requires a larger percentage to get back up to where you were before. The crazy part about this is that this isn't linear, it's exponential. Let's say instead of losing 10%, you lose 50% on one trade. That will bring you down to $50,000. Now, in order to get back up to break even at $100,000, you don't need to just go up 50% or 60% or 70%. You need to go up 100%. You need another 50,000 on top of your current 50 just to get back up to where you were before. And to take this to the extreme, let's say you lose 90% on one trade. Now you're left with only $10,000. In order to get back up to $100,000, you need to make another 90,000 back, which is 900%. So the larger your position size is in any given position, increases the likelihood that you will have a large drawdown on your entire portfolio. And the larger that drawdown is, exponentially larger gains are required just to make back what you lost. And so if you want to maximize your chances of losing everything trading or investing, go all in on individual positions. Fully concentrate. This means that the inverse of going all in is to spread your investment portfolio out among many different bets, many different positions. And just as one little caveat, one little note, if you have many positions that all go up and down together, maybe you have 500 different stocks and they're all part of a list that most participants in the market are all buying and selling those stocks at the same time. You don't really have 500 different positions. You really have still one big position. So just because you're in an index fund doesn't mean you're actually diversified. Hey, real quick, if you are an active investor and your portfolio is not growing as fast as you'd like, then I would like to give you a free gift. This is something I've been working on for a long time. My team and I put together a portfolio stress test. We looked at the top 6 risks that people are exposed to in their portfolios, many times without even knowing it. And most importantly, what you can do to fix it. So we built this really cool questionnaire quiz on my website where you can input all the information about your portfolio, your investing goals, and then it's going to spit out for you a customized blueprint that shows you where you're currently at and what you need to do to get to the next level. So no matter what is holding your portfolio back and no matter what risks you're exposed to, maybe without even knowing, I want to help you find and fix your vulnerabilities, again, completely free. Once you go through this little 1-minute questionnaire on my website, it's going to send you a customized blueprint to your email, PDF you can download and you can keep it forever. And that's going to give you access to all of my courses. I've created literally hundreds of hours worth of educational content that I used to sell for hundreds, sometimes even thousands of dollars. This is now my free gift to you. You can access it 100% completely free of charge. It's going to give you all the education, all the strategies and tactics that you need in order to fix your portfolio. All you need to do is go through the questionnaire, open up the email, save that PDF, and get to work. So if you'd like to take advantage of this, all you have to do is go to my website, heresy.financial/stress test. The link is in the description below as well. It's heresy.financial/stress test. Plug in your portfolio information, and I'll send you your custom blueprint 100% free. All right, the third way that you can maximize your chances of losing everything trading is to focus on the profit potential, not the loss potential. We've already covered how losses are more powerful. They're exponentially more powerful than gains. So we want to ignore that. We only want to focus on the profit potential. We don't want to ask how much could I lose on this? We want to ask how much I could gain on this. This means we're going to be filtering out stocks or companies or investments that have limited downside risk, any margin of safety. We're not going to be worrying about hedging. We're not going to be worrying about stops. We're not going to be worried about position sizing or anything like that. We're only going to be finding things that we think have the potential to make us massive amounts of money. We're going to be looking for stocks that have the potential for one FDA ruling to 10x the company overnight. We're going to be looking at penny stocks that have the ability for some pump and dump marketing scheme to throw the stock into the stratosphere. We're going to be filtering out companies that have a really strong history of just good, consistent growth, because in our mind, those don't have massive upside profit potential from here. We're always going to be looking for the next lottery ticket. And because of our focus and our filters, it means 99 times out of 100, we're going to be picking fairly low quality investments, and the profit potential that we are seeking is likely to not be realized. And because we are not focused on the loss potential at all, we'll be able to keep that in the blind spot, and it'll sneak up on us and drive our overall portfolio performance much lower. This means that the inverse rule of this, if you don't want to lose money trading, would be exclusively focusing on the loss potential. We want to make sure everything that we are looking at through the lens of how much could I lose on this? What is the real risk? Making sure that no matter what we do, we are not risking large losses. All right, the next thing that you can do to maximize your chances of losing everything trading is entering a position before we know where we are going to exit. We see a stock pop up on social media. We hear somebody, an Uber driver talking about how much money they've made on some stock. We see something pop up in the news and we think, you know what? I'm just going to go buy that. We don't plan our exits before we get in. The brilliant part about this is that no matter what happens, we don't know when we are going to get out. If the stock rises 20%, 100%, if it falls 50%, no matter what happens, we are always left asking the question, when should I sell? And because we never made a plan before we actually entered, we let emotions drive our decision-making in the moment, which means we have a small loss, we let it turn into a big loss, and we're scared to take it because we don't want to have that loss. So it ends up becoming a big one for us. When we see those profits, usually we end up taking them early because we didn't plan our entry before, so we don't know how much more it's going to go up. So we don't have any large gains that drive our portfolio performance. And even if we do, a lot of times we hold on too long and the profits evaporate again. So by blindly entering positions and making sure that we don't have an exit plan before we enter, we ensure that those emotional decisions will drive our behavior. And the result of that is usually many large losses and a few small wins. This means that the inverse rule, if you actually want to make money, would be never enter a position until you know your exit, both on the upside and the downside. If you know where you're going to get out if you start losing money, if you know where you're going to get out if you start making money, then you have made that decision without the emotion of having the money on the line. So you're more likely to make a rational or a logical decision about it. And you can actually analyze whether that trade or investment is worth it to you. You look and you say, okay, I've got a 10% downside here, 50% upside. You can say, that's a bet that's worth taking. But if you look and you say, I've got a 50% downside and a 10% upside, you can say, you know what? It's actually not worth taking. So if you want to make money, always plan your exit before you enter, because then you know if it's actually worth entering. And then the key there is stick to your plan even once you enter, even though you have that money on the line driving your emotions. Don't let the emotions change your behaviors. All right, the next way to maximize your chances of losing money trading is to focus on the odds and the probabilities. Treat the stock market as if it is a game bound by a set of rules, similar to a casino or a lottery. Treat back tests as if they are future law. Think that past performance is a guarantee of future returns. And look at all investments and all trades and say, I know what the odds are here. I know I've got a 50% chance of making money or a 50% chance of losing money or whatever you think the odds and the probabilities are. Because that way, when you think you know the odds, you will then be able to apply the correct position sizes and the correct amount of leverage, and you will be guaranteed to make money, or in this case, lose money, because the odds are unknowable. There are two sets of probability distributions that govern things in the universe. We have normal distributions or Gaussian distributions. Those look like a bell curve. This would be things like the distribution of weight of humans. You're going to have the vast majority of the population be in the center of the bell curve, and you're going to have some outliers of people who weigh very little and some outliers of some people who weigh a lot. But the vast majority of people are going to be in the middle, somewhere around probably 150, maybe 160 pounds. Some people will weigh up to like 1,000. Some people will weigh as little as like 50 or 60 pounds. But again, 99% of the population is going to be clustered around the middle. This works for things like human height as well. This works in any system where you don't have inputs and outputs of exchange in between individuals in the system. The second distribution curve that we find in nature is a power curve or a Pareto distribution. And this is one where a few nodes or individuals in the system contain the vast majority of the outcome. And then the vast majority of the individuals or nodes in the system have a small amount of the outcome or the output distributed among all of them. This would be things like human wealth. You have a few people who have most of the wealth, and then the vast majority of the population who has the rest of it. This is not a wealth thing. This is something that is identifiable in any system in nature that has inputs and outputs and exchange between individuals in the system. You find this exact same power curve with the mass in stars in the galaxy. 90% of all of the mass in a galaxy is contained within about 10% of the stars. You find this in population in cities. About 10% of the cities have 90% of the population. You find this with music. About 10% of music artists have 90% of all listen time. You find this in sports. About 10% of the athletes have 90% of all of the money for the professional contracts. And you find this in markets as well. A few significant events in the market contain the vast majority of the overall moves, and the rest of the events in the market contain very, very little of the overall movement. And this is why if you want to lose money investing, focus on the odds and the probabilities, because it assumes that you know what those outcomes can be. It assumes you're living in a normal distribution of events with a normal distribution of outcomes, but that's not how markets work. You have an unpredictable number of events that have completely unpredictable outcomes, where the extremes can always be more extreme than the last extremes were. And so if you focus on the odds and the probabilities, you're assuming that you can know what those odds and probabilities are, which you can't, which means you're almost guaranteed to lose money from them. The inverse of this would be to assume you cannot know the odds and the probabilities. And so since you cannot base investment strategies based off of, hey, I think that my probability or my odds with this are X, Y, or Z, then instead you're going to have to focus on something else like managing risk. Say, instead of focusing on the odds, focus on how much could I lose on this. All right, the next way to make sure that you maximize your chances of losing everything trading would be to take profits aggressively. Because after all, nobody ever went broke taking a profit, right? There are only 5 outcomes that you can have with any individual investment. You can make a lot of money, make a little bit of money, make nothing, lose a little bit of money, or lose a lot of money. If you always take profits aggressively, that means anytime your position moves from 0 to a little bit of a profit, you're going to take that profit, which means you always eliminate the chance of big profits. That means that you're left with the chance of making a little bit, making nothing, losing a little bit, or losing a lot. Your little wins and your little losses will cancel each other out, and your portfolio performance will be driven by your large losses. If you take profits aggressively, you never, ever, ever have the chance of a little winner becoming a big winner. And so if you want to maximize your chances of losing money investing, you need to get rid of the chance of making a lot of money on any individual investment, which means anytime you have any profit, take it. Now, obviously, the inverse of this would be don't take profits aggressively. Let your winners run. This is why some of the best investors and traders throughout history always say the exact same thing. Warren Buffett says his ideal holding time is forever. He wants to just hold on to companies and let them grow and compound forever. The inverse of this is also to take losses aggressively, because if we look at those 5 outcomes again, if you always take every small loss, you never have the chance for a small loss to turn into a big loss, which means your small losses and your small wins will cancel each other out, and your big wins will drive your overall portfolio performance. And that leads us into the last way to guarantee that you have the highest chances of losing money trading, which is to never take losses. Because even if you're following number 6 and you're taking profits aggressively, maybe you're also still taking those little losses aggressively. So you need to make sure that you never take losses. If you have a little loss, you always hold on to it just for the hopes that you can get back up to at least break even. The reality is, large losses always start off as little losses. You cannot have a large loss that did not start off as a little loss. And so if you never take those little losses, you maximize your chances of being able to get as many large losses as possible. And that will maximize your chances of being able to lose money investing. This means the inverse of this will be to always aggressively take as many small losses as you can. Cut your losses short. This is why the best investors and traders throughout history who make the most amount of money always say cut your losses, manage risk, never lose money. And there are plenty of ways to do this. There's not a one size fits all. Warren Buffett does this by investing with a margin of safety. He dumps stocks when the management changes, when the cash flow changes, when the profits change, when the fundamentals that he bought the company for change. Day traders do this by setting stops. Swing traders do this by stops or sometimes hedging with options. There are plenty of ways that you can manage your own risk. You can even do it just straight up through position sizing. If every single one of your positions is only 0.5% or 1% of your portfolio, the most you can lose on any position would be 0.5% or 1% of your portfolio. There's no best way or right way to make sure that you are taking your losses and managing your risk. But if you want to maximize your chance of making money, then you always want to aggressively limit your risk and take those little losses. Take care of your losses and your profits will take care of you. So that is 7 ways to maximize your chances of losing everything investing and trading. And so if you take those to heart, flip them around and just do the opposite, then instead you're going to be maximizing your chances of making the most amount of money possible investing and trading. My hope for you is that you do the opposite of these. One last note, if you're an active investor and your portfolio is not growing as fast as you'd like, my team and I put together a completely free gift for you. It's called the Portfolio Stress Test. All you have to do is answer some questions about your portfolio and your investing goals, and then it will email you a custom blueprint that will help you fix the vulnerabilities in your portfolio that you maybe didn't even know were there. It's also going to give you access to all of my courses, hundreds of hours of education, strategies, tactics on investing and trading that you need in order to fix your portfolio. Again, this is all completely free stuff I used to charge a lot of money for. Your gift free. To access it, just go to heresy.financial/stress test. The link is in the description below. Fill out the questionnaire, plug in your information. I'll send you that custom blueprint. You can get started. As always, thanks so much for watching. Have a great day.